Hi folks, Chris Rich here. Welcome back to the channel. In this video, I'm going to tell you why investing in individual stocks is riskier than you may think and even potentially detrimental to you and your family's financial security. Now, if you currently invest in individual stocks, don't feel bad. Wall Street and its cohorts have done everything in their power to make it seem as though it's a winning strategy. Or maybe it's something you learned from your father or a close friend. And at one time, it was generally believed to be a winning strategy. However, with the data and research available today, you're going to see that the odds are stacked against you if you continue to hold individual stocks. This video is on investment principle number 7 of 27 investment principles every investor should know. These investment principles are all time-tested. They're backed by economic and financial science. I've broken them down into bite-sized digestible pieces, easy to understand and implement into your investment life. Over the past 30 years, I've helped hundreds of people implement these principles into their investment life. I've watched these principles work firsthand. I know they can make a real difference in your life. I highly encourage you to implement these investment principles into your life. It's surprising to me today, with all the scientific and academic research available, that people still believe holding individual stocks is a winning strategy. Burton Malkiel, a Princeton professor, clearly points out in his famous book, A Random Walk Down Wall Street, now in its 12th edition, that stock prices are totally random. Folks, if stock prices are totally random, why would anyone with a rational mind try to pick individual stocks as an investment strategy? In my 30 years of real life experience, I've heard all kinds of stories. Well, this is the way my dad always did it. Or, my late husband left me with this portfolio. I can't bear to make the changes. He was a very smart man. I've also heard my best friend knows someone who's done very well with this particular stock. I think it's a good investment. A famous one. I spent my entire career with this company. I know it's a great company. I'm not going to sell this stock. Or, I've spent a lot of time and research checking this company out. I know the company is going to do well. Folks, your thoughts, feelings, and research have nothing to do with the price of a stock that you own. If someone close to you has suggested a certain stock, or if you've put a lot of time and research into the outcome of the trade, you may feel irrationally that you are in some sort of control over the outcome. This is almost never true. Now, even when people realize or become aware that they're being irrational, they tend to overweight the likelihood of a positive outcome, while underweighing the probability of an extremely negative outcome. What's an extremely negative outcome? Nortel, Enron, Lehman Brothers, Bear Stearns, and those are just some of the big names I've picked to make my point. There are many, many more, probably that you haven't heard of. My point is this: stocks can go to zero. It's totally possible, and it's not unheard of for companies to disappear and take their share price with them. A total loss is unlikely, however. Much more likely than a total loss is a long-term underperformance of the market, or the suffer of a permanent loss in your portfolio. In May of 2018, a paper titled, "Do Stocks Outperform Treasury Bills?" Henrik Bessenbender of Arizona State demonstrated that the vast majority of stocks that have appeared in the Center for Research and Security Pricing database, which is a comprehensive database of U.S. stocks, since 1926 have a lifetime buy and hold return less than the 1-month Treasury bills. In other words, you would have been better off taking no risk with your capital than investing in most individual stocks. What does most mean? It means that the best performing 4% of listed companies explain the returns of the entire U.S. stock market since 1926. The remaining 96% of stocks collectively match the return of Treasury bills. That means that you would have been better off taking no risk at all than holding 96% of U.S. individual stocks since 1926. I'd call your chances of picking a winning stock pretty bad. And the data only gets worse the deeper we get into it. The rates of underperformance are worse for companies that have entered the database in recent decades. J.P. Morgan did a study in 2014. They studied the Russell 3000 going back to 1980. Now, the Russell 3000 includes most U.S. stocks. The study shows that of the 13,000 stocks that have been included in the Russell 3000 between 1980 and 2014, 40% of them have suffered a decline of 70% or more from their peak value without a significant recovery. The study shows that their losses don't only happen during recessions or market corrections, they're happening steadily all the time. This is probably not the data people are considering when they invest in individual stocks. They probably see all the glamour and money that they're going to make. I doubt that most people have any idea how bad the odds are stacked against them. Historically, you are far more likely to pick a loser than a winner. And that loser is far more likely to not only trail the index, but also have a negative absolute return. Folks, if you still have the idea that holding individual stocks is a winning strategy, I'm not sure what to say. The scientific data goes much deeper than what I've covered in this video, and the odds are not in your favor. Holding individual stocks is totally irrational. Folks, I encourage you to implement investment principle number 7. Don't buy individual stocks. If you've learned something of value from this video, share it with a friend and hit the subscribe button. Then you'll be notified when future content becomes available. Thanks for watching. I look forward to seeing you on the next video.